Jeff Currie of Carlyle writing this: the cost of rebuilding and recovering from the Hormuz shock will be enormous and underscores the regime change towards physical assets. Jeff joins us now for more. Jeff, welcome to the programme. It's always good to catch up with you, sir. Fluid environment, so allow me to go through the headline of the last 5 or 10 minutes or so. One headline, one report coming from Iran that their energy assets have been struck. Now, I have limited information beyond that, but Jeff, from your standpoint, in the week since we last spoke, has this got worse or better?
Worse. I like to call it molecular contagion. Last week we were talking about shortages in Singapore. Prices of jet fuel spiked to $230 a barrel. This week, it's in Rotterdam. Rotterdam's $220 a barrel. Thailand, Philippines, New Zealand, Australia. So this thing's going intercontinental. And, so you look at Singapore, Rotterdam, the spread, there's no more price spread. There's no more spare barrels. There's no policy fix, and it's just physics at this point. And I want to emphasize, these are physical supply chains. And that the idea of around financialization and the ability to print money doesn't apply here. And I think the title of that piece says it all. You can't print molecules.
Jeff, with that in mind, where and how do you think we're underpricing this risk still in financial markets?
That's the peculiar thing about this, is that you look at the paper markets, they've entirely disconnected from the physical markets. Crude oil on an Oman basis, on the other side of the strait, the side that's free, spiked to $173 a barrel yesterday. Crude delivered in Asia is a blend of Dubai and Oman, which is trading somewhere around 130 and 170. And today, this morning, they're call it 120 to 150. So you're delivering crude into Asia at somewhere around $130 a barrel. Product prices are spiraling above $200 a barrel. So the disconnect is between the paper market, which is sitting around 100, and the physical market, which is showing a very different environment.
Jeff, some people have speculated that's because of certain types of manipulation in the futures market, and that's the reason why you have seen this gap blow out. Do you think there's credence to that?
You could argue that Monday last week, there was a mysterious 11 million barrel seller. I don't want to get into that. It's not enough to really change the dynamic. I think that the bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. I go back to the point that John started with is, we're dealing with an enormous supply shock. By the way, the supply shock is almost equal to the demand shock during COVID. And we know what that did to global supply chains. So I think at $100 a barrel, this thing's mispriced, even against the physical market.